Today, I'm going to be revisiting utility companies again as an update to my 2018 video. Again, the reason why you want to own a utility company in your dividend portfolio is because of their long history of paying and growing their dividends. And on top of that, the last time I checked, people still need heating and electricity, so I don't see them going out of business anytime in the future. First, a disclaimer, I was going to say I'm not a financial advisor, so please do your own due diligence before investing. First, I look at 10 different utility companies. It took a long time to collect and analyze this data. So if you appreciate this or find this useful in any way, all I ask for is for you to like the video. I really appreciate it. First off, when you take a look at these 10 different utility companies, you notice that they all have substantial amount of debt, and that's normal among utility companies because of the massive amount of infrastructure required for the business. But overall, I'm not going to be going over all the numbers right now. I'll be going over them throughout the video, but there is a few that I want to point out. Take a look at Algonquin Power and Utility. Their PE ratio is much higher than the rest. They also have a very high payout ratio. Even in the past, their payout ratio is usually around 100% or over. Their price to book and price to sale ratio is also much higher than the rest. Next one is Northland Power. Their payout ratio may be around 80% this year, but in the past, almost every year besides this year, their payout ratio is over 100%. Even based off their cash flow, their payout ratio is usually around 100%. Their price to book and sales ratio is also much higher as well. When we take a look at the revenue, it's a little overwhelming looking at all these data points. If you want to take a closer look at each company, feel free to pause the video. But the two that I found interesting was TransAlta and Capital Power. TransAlta hasn't been growing the revenue for almost 2 decades already, and Capital Power's revenue has been declining over the years. And on top of that, those two are the two smallest companies. Call me biased, but I much prefer larger utility companies. When we take a look at their yearly profits, this chart is even more of a mess, but let's slowly pick them out. First off, you notice a big drop in Hydro One, which is mainly due to a one-time charge they received from the regulators to force them to share their $2.6 billion in future tax saving with their customers. The few I want to point out is TransAlta again, with their flat to declining profits from the recent few years. We also notice a small little hiccup with ATCO in the recent few years. We'll see if they can get back on track to continue growing their profits. But one very interesting one is Capital Power. They are growing their profits with a declining revenue. When you look at the yearly dividends, it's a little cluttered again, but most of them are trending upwards, but there are a few interesting companies. First off, Hydro One. The one in the green may look like they cut their dividends, but they didn't. In 2015, before they went public, they made a special dividend to investors, which is why we see a big spike up. But the two that did cut their dividends is Algonquin Power and TransAlta. As a dividend investor, this is one thing that I absolutely do not like to see. You'll also notice that Northland Power's dividend has been pretty much flat, with pretty much no growth. Next, I want to take a look at their profit margins. I know this is not an accurate look at the company's profit margin as they do depreciate their assets, but if you take a closer look, you'll notice something interesting. First thing you might notice is that some spike around a lot, but if you zoom in a bit, you'll notice that some are very consistent. I like this stable outlook. I want something that can consistently generate me a return on my investment and not one that jumps around all over the place. Because eventually you'll be hit with a year where they can't afford to pay the dividends and they'll have to cut or stop it. I'm not surprised to see TransAlta spiking around a lot, but Northland Power also spikes around a lot too. Even Brookfield isn't that stable, but at least it's positive unlike TransAlta and Northland Power. So by looking at those several charts, there are some that I want to eliminate right off the bat. First is TransAlta for sure. Not only does it have a flat revenue growth and a declining profits, they also have cut their dividends many times in the past as well. I'm also going to eliminate Capital Power too, mainly because of the declining revenue growth. Even though it's growing its profits and dividend, there's a limit how far it can go with declining revenue. The third one I'm going to eliminate is Algonquin Power because of their dividend cut in the past. I absolutely do not like dividend cuts. On top of that, all three of these companies have a very high payout ratio. If you look at the past years as well, they're usually around 100%. At these levels, I don't know if they can sustain it over the long term. If there are any hiccups, we could see them cutting the dividend. On top of that, I want to see them investing some of their profits back into the company to further grow the company as well. So that's 3 out of 10 eliminated. The next one I'm going to eliminate doesn't have a severe issue as the other 3. They have been growing the revenue and profits over the years, but their profits does spike up and down a lot in the past. The main issue I'm eliminating is because of their abysmal dividend growth and their big payout ratio. Their payout ratio based off their EPS is usually well above 100%. and based off their cash flow may not be over 100% this year or the last several years, but from 2015 and before it has been around 100% or over. How can they afford to pay it? I'm not sure, but all I know is I don't like it, and that company is Northland Power. I'm also not a big fan of Brookfield either because of their massive payout ratio, but since they are the largest by market cap and they have been growing the revenue and profits and also dividends, I'll leave them in this comparison. So now we're down to 6 out of the 10 we started with. Again, let's take a look at their data points now. There should be less clutter now and easier to interpret. But first off, I just want to point out the massive PE ratio of Brookfield and their large price to book and price to sales ratio. All the other ones are fairly equal when looking at these stats. When looking at their stock performance, we clearly have one winner, Brookfield. All the other ones have performed fairly equally except for Hydro One, which has pretty much been flat. When we take a look at their analyzed return, you'll notice some great performance among them all this year. Investors are moving away from risky assets. A few things you might notice is that Fortis and Emera has had a very similar return over the years. Canadian Utilities and ATCO has also had similar returns as well, but that's because ATCO has a 52% stake in Canadian Utilities. When looking at the chart, we see very consistent returns over the years with a similar trend among them. The only one that's slightly out of place is Brookfield, but it looks like it has fallen back into place with the others. When we take a look at the revenue, after eliminating some of the companies I found less desirable, we see a general trend upwards, and they all look great. Of course, this is what I expect after vetting out the bad ones. Again, besides the little hiccup we see in ATCO, we see a similar trend upward for their yearly profits as well. Just ignore the recent data point for Hydro One, as if we remove that one-time charge they received, it would have been a positive growth year as well. Same trend again for the yearly dividends, just remember to ignore that one data point again for Hydro One relating to that special dividend investors received before they went public. When we take a look at their dividend growth, ignore Hydro One as the data is not entirely accurate as the one-time special dividend payment has affected the numbers. If we remove that one-time dividend payment, they would have had positive dividend growth every year as well. But the stock is still fairly new as the company has only went public back in 2015. So we don't have a very long history yet. But other than that, overall we see a stellar dividend growth over the years, exactly what I would expect from a utility company. When we take a look at the chart of their dividend growth again, ignore Hydro One. A few interesting points is that ATCO and Canadian Utilities have really ramped up their dividend growth over the years, but in the past several years they have maintained their dividend growth. Brookfield has been slowing down their dividend growth over the years, which I'd expect from their high payout ratio. I'm a little surprised to see the dip in Fortis' dividend growth, but their dividend growth has been very consistent over the years with a long history, and they have maintained a great payout ratio and slowly growing their dividends as the company grows, which I like. I don't want the dividend growth to outpace the company growth by a lot. Emera didn't perform as well in 2016 and 2017, which is probably related to why the lower dividend growth in the recent few years, but still positive dividend growth though. During those 2 years, they had a payout ratio at over 100%. But besides those 2 years, they averaged around 70 to 80% payout ratio, which is fine. So in my personal opinion, out of these utility companies, which one do I consider a buy? I'm going to be listing 5 that I consider better out of the group. Even though Brookfield is the largest with the best stock performance, based on their statistics, I can't seem to recommend it myself. But I do like Fortis, Canadian Utilities, and ATCO, as they have a very long history of increasing and paying their dividends. They also have a decent yield with a decent payout ratio, not over 100%. Emera also looks fine as well. If you look past 2016 and 2017, they would fall in the same club as the other 3. And Hydro One is still fairly new, without a long history like the others, but it's off to a good start. The reason why I don't recommend just one is because it's good to own multiple utility companies, to diversify yourself among them as well. All the ones I mentioned have all performed well, with good yields and decent payout ratio. By spreading your investment among them, you can help reduce your risk and purchase ones that are on sale. And as always, if you enjoyed the video, please like and share the video. I really appreciate it because making this video takes a lot of time to do the research on these companies, and it really helps out the channel, and hopefully we can reach more people and help them make better financial investments. And if you haven't subscribed yet, please make sure to smash the subscribe button, and thank you for watching. I'll see you in the next video.